Hello and welcome to this week's economic update. My name is Lindy Pond and we're going to jump right in. All right, so there is this thing called the Mortgage Credit Availability Index, and what it does is it measures the credit availability for mortgages. A decline indicates lending standards are tightening, while an increase indicates that lending standards are loosening. This is very important because right now in the environment that we're in, mortgage credit availability is definitely tightening. Take a look at the graph. And chief economist from MBA, Joel Kahn, said credit availability in November declined to its lowest level in 4 months, driven by reduced offerings of non-QM and jumbo loan programs. Overall credit availability was 7% below last year's levels as the industry has reduced capacity in response to declining origination volume and lenders continue to simplify their loan offerings. So lenders are offering less different types of loans to help decrease their expenses and their costs, their staff, their overhead, things like that. At the same time, lending availability is tightening through banks and in the secondary market. So heads up, double check to make sure that if you're working on getting a loan, that the guidelines haven't changed, the loan program is still available, as things definitely are tightening up out there. The November ADP employment report, remember there's two different employment reports. There's a private sector from ADP, and then there's the public one we'll get to next, the government one, which is from the BLS, Bureau of Labor Statistics. So the November ADP said that there were 103,000 jobs created, weaker than the 130,000 that was expected. This follows a weaker October, showing us that the job market is certainly cooling. Annual pay for job stayers increased 5.6% year over year and unchanged from last month. Annual pay for job changers saw an increase of 8.39%, down from 8.4% last month. So not a whole lot of change there, but you can see that the market definitely is cooling because you don't see the increase growing. Pay is cooling as well, marking a 17-month decrease. Now to the BLS, the Bureau of Labor Statistics of government. They put out a survey, and it comes into two sides. Remember, there's the business survey and the household survey. So the business survey comes from modeling and estimations, and November reported 199,000 new jobs, very close to the 103. Kind of sort of close to the 103 from ADP, which was surprisingly stronger than the expectation of 190, so a little stronger. Hourly earnings fell 0.4% from last month and remained at 4% year over year. Average weekly hours rose slightly from 34.3 to 34.4. Not much there. Still in line with the ADP report. Now, the household survey, which is where this one's a head scratcher, this comes from literally calling households and asking questions. It reported a whopping 747,000 jobs created. That's the head scratcher. The labor force increased by 532,000. So what is that? All of a sudden, people realized they need more income, so they got back into the labor force. They were out of it before, then they got back in. I don't know, but that is so far off from both ADP and the business survey, 747,000 jobs. So I imagine there'll be some corrections next month on that one. This resulted in the unemployment rate decreasing from 3.9% to 3.7%. Our herd on the streets for the week, per ADP, productivity increased by 5.2% in Q3, resulting in a lower total labor cost, which is good for corporate profits and helps us to lower the inflation number. The Manheim Used Car Index report showed used car prices declined 2.7% in November and are now down 5.8% year over year. This certainly helps inflation. 47,000 of those job gains came from returning auto and film strike workers. The strikes are over or resolved, and so remember that got us about 47,000 workers back into the workforce. Fed Chairman Jerome Powell is expected to make comments this week to calm down the market expectations for Fed cuts within the first half of the year. The market has been reacting, as we will see on the next slide, and is thinking those Fed cuts are coming sooner than the Fed would like you to think that they're coming. So the weekly conventional mortgage rates, owner-occupant, remember owner-occupant primary residence, they went for last week from 7.17 to this week of 7.07. So we're right above 7%, a nice decline in the last 6 months, as you can take a look at the graph. This has also helped our DSCR rates. I'd say now we're in the high 7s to low 10s. Of course, the rate on DSCR loans depends on credit, LTV, and your DSCR calculation. Remember, if there's anything I can help you with your real estate investor financing, you just let me know. Thank you.